Namaskar friends, welcome to the channel JIV and CIV Made Simple. Today in this particular video, we are going to discuss our certification examination in foreign exchange operation 10 January 2026 memory based question with their explanation. These are some questions which we have collected from the aspirant who have appeared in the examination, and you will get to know what kind of questions are being asked. Obviously these are case studies oriented. Now we have shifted our pattern. Earlier they used to be one liner question, but this is no longer. Now it is completely case study based. So that's why we have also shifted our methodology of studying. We have been adding only case studies type question, so that you can practice these type of questions sufficiently before the examination and you feel confident in the examination. So let's get started with our first question. The question is like this: while scrutinizing the bill of exchange, that is the draft, in an LC presentation, which of the following is incorrect? That's the question. While scrutinizing the bill of exchange in an LC presentation, which of the following is incorrect? So the option they have given that it should be signed by the drawee, it should be drawn unconditionally, and should be free from any extra condition. The tenor of the draft should be in accordance with that of the credit. The draft, that means draft means letter of bills of exchange we are talking about. The draft should be drawn in the same currency as that of the credit. These are the four options that have been given. You have to tell which is incorrect. Drawer may be exporter, right? And on the other hand, we have drawee. So drawee is the person who has to pay. Drawee has to pay. So drawee may be buyer or drawee may be importer. To the context of LC, we are calling it importer. So the question is, who sign it? If you look at the option, that it should be signed by the drawee. So who sign it? Obviously the drawer sign it, because he is giving the order. So BOE is just an order to pay, and it is given by drawer to the drawee. So obviously one who will sign, obviously one who is giving the order will sign. So drawer will sign. So option number A is wrong, right? So if the drawee sign, it become an acceptance, not the original bill. So if the drawee sign, it become an acceptance, right? It is not an original bill. That's why option number A is wrong. Now let's look at option number B. It says that it should be drawn unconditionally and should be free from any extra condition. I think this is the correct one. Why? Because to the context of LC we are talking about, right? Bill of exchange to the context of LC. Many times I have told you that bank always deal in the document. That's why LC is called documentary letter of credit. Bank does not deals in goods. Bank always deals in document. Bank does not deals in goods, right? So if you add some condition like pay only if goods are perfect. Pay only if goods are perfect. Suppose you add this kind of condition, right? What will happen? So in that case it is invalid. It become invalid, right? It become invalid. So that's why this call that this will no longer be so there is no condition involved, right? That's why it is unconditional. It is correct. Option number C says that the tenor of the draft should be in accordance with that of the credit. So yes, that is the correct one. So tenor must be matching. That's called matching tenor. Yes. So payment timing, like it may be at site, or it may be UJANs for 90 days or something like that. So payment tenor, it may be at site, or if you talk about UJANs bill, so payment tenor must match. Tenor must match, right? So it must match the LC terms. So yes, option number C is also correct. What about D? D says that the draft should be done in the same currency. Exactly. So let's say that your letter of credit is in dollar. Let's say your letter of credit is in dollar. Okay. So the draft or the bill of exchange, it must be in dollar. No mix up is allowed, right? Please understand, these are the very important thing. Most of the time we just ignore such kind of information, but they're asked in the examination. So 4 different concepts based on bill of exchange. So option number D is also correct. So the correct answer to this particular question is obviously option number A. The question is which is incorrect. So obviously A is incorrect. So this is our correct answer. So remember, what we learned from this discussion is that drawee never sign the draft. Please understand, drawee, he will never sign, right? So drawer is the draft maker. Who is the draft maker? Drawer is the draft maker or bill of exchange maker, right? So what we have discussed, what we have learned from this discussion is that bill of exchange is an unconditional order to pay. There is no condition involved, because bank always deal in the document. Bank does not deal in the goods. So you cannot attach any condition. Second thing is that tenor and the currency, they must match. and bank always check document, bank never check goods. I hope these things are crystal clear. Now friends, let's shift our focus to the next question that we have. So this way we have summarized everything here in this particular PDF. You can see question number 2 is on your screen. Exactly same question was asked in the examination. So this is all about, which of the following payments is deducted from export proceed of an export oriented unit, that's called EOU, when calculating its net foreign exchange earning for a 5-year block. Very good question it is. Option they have given: payment in INR for purchases made against a high sea sale agreement. Option number B say payment in INR for raw material sourced from local domestic supplier. Option number C, payment in foreign currency for all the commission paid. Option number D, payment in foreign currency for all the import made by the units. So these are the 4 options that they have provided. Now you have to select the correct one. So let's first of all clarify our basics. Right, let's clarify our basics. So have you seen this word HSS? That's called, high seal sale agreement. Let me clear it. What this is all about. So whenever I say HSS, this is called, high sea sale agreement. So you know what it is all about. It means, you are buying imported goods. It means, you are buying imported goods. You are buying imported goods before custom clearance. You are buying imported goods before custom clearance. Right. So even though you pay in INR, these goods are originally import. See, even though you are paying in Indian rupees, but these goods are originally import. So whenever we do NFE calculation, you know what is the meaning of NFE? Right. So whenever we do NFE calculation, that is called net foreign exchange calculation. Right. So these INR payment is treated like a foreign exchange. Please understand, whatever INR payment you have done, they are treated like a foreign exchange. Right. Foreign exchange, they are treated like a foreign exchange outflow. They are treated like a foreign exchange outflow. And they are deducted from what? They are deducted from export proceed. They are deducted from export proceed. So that is the point. So that's why if you look at the option number A, that the payment that you made in INR for purchase made against HHS, these are deducted. So option number A is correct. What about B? B says, local domestic supplier. Commission, actually B is all about, local raw material in INR. So this is not deducted because, domestic purchase don't affect any foreign exchange. See, we have to see that which option is affecting our foreign exchange. Tell me, whether any domestic purchase will affect the foreign exchange? Obviously no. So B is the incorrect one. What about C? C says, commission in foreign currency. Yes, very good concept. For the commission you have paid in foreign currency. Yes, they are deducted. They are deducted, but the question focus on the unique case of, INR based HSS. Question focused on unique case of INR based HSS. That's why C is also wrong. What about D? D is all about, import in foreign currency. So definitely deducted. You have heard about the CIF value, cost and freight value. But again, the question highlight the HHS logic. So one way to remember this HHS, just you can remember it like this: hidden subtraction in INR. Right. You can think of it like this: even if payment is in INR, it hide an import. So you can think of it like this: payment is in INR, but it hide import. Right. So subtract it. So what we have discussed so far, please understand, whenever a question is asked you what is NFE, so you can see the logic is the same. Right. So NFE formula primarily focus on foreign exchange liquidity. It exclude pure domestic INR spend, but capture forex equivalent. See, if any export realization, you have to add. If there is a high sea sale payment, you have to subtract. Local raw material, no deduction. Import payment, outflow. Commission, outflow, that has to be deducted. Right. So NFE means what? So one simple line we can call NFE, net foreign exchange, at how much is your export earning? How much is your export? If you are looking for foreign exchange certification course, in which you can check out our comprehensive course, in which we provide theory plus MCQs plus case study PDF, unit wise theory video explanation, And in addition to that, we provide you previous year questions. You can see case studies, separate folder I have provided, previous year questions, separate folder I have provided, unit wise theory and MCQ PDF. And if you want to quickly revise, we have module wise quick revision PDF. In addition to that, we have unit wise theory video explanation, where every unit video have been explained in English language in very lucid terms. And also, for your information, let me tell you that the recent pattern in which only case studies are being asked. So we are constantly being upgrading our material and adding more such kind of questions, more such kind of PDF, where you get to practice such kind of question. So please check out our course on our JIV and CIV Made Simple app. The link of the app is provided in the description section. Or you can, most of the India's recent customer trade facilitation initiative, such as the time release study and the risk management system, are primarily guided by the standards and convention of which international body? Option they have given: UN, WCO, World Trade Organization, and Directorate General of Foreign Trade. So friends, very good question. So the option they have given UN. So what about UN? What do you think? So actually, UN gives a broad trade development framework. Yes, so they give trade development framework. Okay, so they don't give custom technical rules. So here what we are focusing on, focusing on custom trade facilitation initiative, right? So UN does not give custom basically custom technical rule. That's why option number A is wrong. What about option number B? It says World Custom Organization. Exactly, this is the correct answer. So if you talk about the WCO, WCO, they said global custom standards. What are the global custom standards? Like you might have heard about RKC. What is RKC? RKC is revised Kyoto Convention, right? So these are the list of simplified procedures. Then you might have heard about the SAFE, right? You might have heard about the SAFE convention, right? SAFE framework. SAFE framework means what? SAFE framework means security plus facilitation. Security plus facilitation. That is called SAFE framework. So basically, if you talk about the TRS, what is TRS? TRS stands for time release study. So India's TRS, it follow WCO methodology. India's TRS follow WCO methodology to measure clearance speed at port like JNCH, right? So India's time release study, it follow WCO methodology for measure clearance speed, to measure the clearance speed. This is an example which you can see the importance of WCO. So this is WCO is the correct answer. What about WTO? So WTO, it provides the legal mandate via TFA. It provides the legal mandate. What is TFA? TFA means trade facilitation agreement, but no operational tool, right? And what about the DGFT? So DGFT is the Domestic Agency for Foreign Trade Policy, FTP, not a global custom standards. So the correct answer to this question is option number B. Please understand, whenever the question pertains to custom, the role is of WCO. WCO means World Custom Organization. And whenever it is related to trade, see, whenever it is related to trade, that's WTO. That's the difference. Custom relate to WCO, trade relate to WTO. So think of custom work, WCO blueprint, WTO only give big picture trade rule. So that is what we learned. So what we learned from this question is that WCO set the global custom standards. You can see this is the body that set the global custom standards. And then we talk about this TRS, which is called time release study, and RMS. RMS full form they have mentioned like a risk management system. So they are based on WCO guidelines. And WTO provide you legal mandate, not technical detail. And DGFT is India trade policy, not international standard. So that is what we come to know, like TRS, WCO, TRS guide, authorized economic operator, WCO SAFE framework. These are the key points. Now friends, let's shift our focus to the near head office, but scrutiny of the balance sheet and CA certificate, which item would an AD bank reject for repatriation? So first of all, let's look at option number A. That's IT consultancy. Yes, this is permitted, right? This is the core permitted activity. So this is the real income. This is their core permitted activity. So this is the real income. They can repatriate. The option number B is the sale of inventory. So obviously, for BO, this is a BO, this is a BO, branch office, right? And there is a topic on BO, you know it very well. So we have discussed in detail about the BO. So for BO, trade income is allowed. Actually, most people are frightened by seeing the length of the question. Actually, the question being asked in the examination are from the syllabus only, but people are frightened from the length of the question. That's why they are constantly saying that the question are very tough. Question is not tough, rather you have to build your comprehensive ability to go through the question fastly and then see what is the key points which they are asking on, and bang on. If you go through the syllabus, it will be very easier for you. So the option number B is all about trading, right? Trading is obviously allowed. Now if you look at the option number C, that profit booked due to upward revaluation of the branch office building, please understand. So this is all about option number C is talking about the revaluation profit. So the question is, will the AD allow the revaluation profit to be repatriated outside India? Let's have a look. So this revaluation profit is just on paper, isn't it? This revaluation profit is just on what? It is just on paper. It is not the real money earned from the business. So what does the RBI rule say? RBI say that you can remit only actual operational profit. You can remit only actual operational profit after tax, right? So it is not imaginary gain from increasing asset value in your books. So suppose your building value goes up. Suppose your building value goes up. That's great for your balance sheet, but you can't send that to your head office. You cannot send that to your HO, right? That's the point. So yes, option number C is the correct answer here. That AD will reject. What about option D? Surplus income generated from the repair and maintenance of the hardware project. So actually, this is the listed permitted activity, that's repair and maintenance. So this is allowed. The correct answer is option number C, which is not allowed. So remember the formula. The formula is very simple. That that remitted profit. So let me write down the formula here. So please remember the formula that remitted profit is equal to realized operational profit minus unrealized gain. Realized operational profit minus unrealized gain. You can think of it like this: cash in hand goes, paper gain stay. So whatever cash in hand, that will go, and whatever on paper gain, that stays. That's the formula. So that's the quick revision. What we have discussed, that branch office can remit net profit after tax from permitted activity. Yes, branch office can remit that. And revaluation gain are notional, unrealized gain are not allowed. Please understand, revaluation gain are notional, and I will always exclude the book adjustment like asset revaluation. So these are the book adjustment, like asset revaluation. These are the book adjustment. We have always to exclude it. We have to always exclude this book adjustment. That's the question. Okay, I hope it is crystal clear. Now have a look at the next question. This question is pertains to NTP. That's called normal transit period. Let's understand what this question is all about. So basically what is happening here, that a textile export in Surat. So a textile export in Surat, they present a set of export document to their bank. What it includes? It includes a bill of exchange drawn at 60 days from the date of the bill of lading. The bank decide to purchase or discount the bill. While calculating the interest and monitoring the realization, how will the bank treat the normal transit period? Very good question. So it is a textile exporter in Surat. He present a set of export document to their bank. Presentation includes bill of exchange drawn at 60 days from the date of the bill of lading. Bank decide to purchase or discount the bill. While calculating the interest, monitoring the realization, how will bank treat the NTP? Option A, add a standard NTP of 25 days as per FEDE rule for foreign currency bill. Option B, add a standard NTP of 20 days as per FEDE rule for rupee denominated bill. Option C, no NTP will be applied because the due date is fixed from the date of the bill of lading. Option D, add an NTP of 15 days for bill sent to Asian and African country. Very good question. So the first option say add a standard NTP of 25 days. B, 20 days. No NTP. C, add 15 days. So what do you think? Please understand. Very good question. It is very conceptual question. Please understand. So what is the meaning of NTP? What is the meaning of NTP? NTP means what? Extra time. Extra time added. Extra time added for transit uncertainty. So you add some extra time for transit uncertainty. there are some exception is that, if the bill due date is linked to a fixed date. Suppose the bill due date is linked to a fixed date. What is the fixed date? Fixed date can be, bill of lading date. Fixed date can be your shipment date. Fixed date can be your calendar date. So in that case, NTP will never apply. Please understand. So NTP means the extra time which is added for transit uncertainty. And if the bill is linked to a due date, like or a fixed date, so like bill of lading date, shipment date, calendar date, so NTP will not apply there. Please understand, that's the rule, that's the key point. So like in this particular case, what we are observing here is that the bill of lading date is drawn at 60 days from the date of the bill. Okay, so in this case, no NTP will be there. No NTP. Why? Because the bill already has a fixed due date. What is the fixed due date? Fixed due date is 60 days from the bill of lading date. And NTP is used when there is uncertainty about when the bill will be accepted. Like in the case of side bill. Please understand, very, very important concept I am talking about. So NTP is used whenever there is an uncertainty, right? Uncertainty about, whenever there is uncertainty about acceptance of the bill. Whenever you have uncertainty about the acceptance of bill, there NTP will be used. Like take the case of side bill. It's about side bill or bill drawn after side, right? But here the maturity date is mathematically certain. As you can see, they have mentioned that the maturity is 60 days from the date of the bill of lading. So the bank does not need to add extra transit day. Please understand. So the answer will be option number, no NTP will be applied. Yes. So the memory trick is that, fixed date, no extra day. Right? Or simple, if day is fixed, NTP is fixed. So NTP is for site and demand bill or after site bill. For UGENS bill with fixed date, NTP is not applicable. So that's the concept. No NTP when maturity is certain. That is the main concept. I hope it is crystal clear. Now friends, let's shift our focus to the next question that we have. An Indian exporter is finalizing a shipment and submitting document to their bank. Some data has been provided. Like you can see that the following data is available. FOB, free on board pricing, total manufacturing cost they have given, packing and local transport cost they have given, profit margin, export incentive, exchange rate, all this data have been given related to FOB pricing. And the second case is bill negotiation. So bill amount is $1 lakh, retention in the EFC account is 20%, exchange rate is 82 rupees, interest rate is 12% per annum, transit plus UGENS period is 90 days. Now the question is based on the part A data. First of all, let's see the part A data. Based on the part A data, what is the final realizable FOB value in INR that the exporter will use for finance eligibility? So we will solve a practical export finance question involving FOB pricing and realizable value. So basically in nutshell, we can say this question pertains to, FOB pricing, free on board pricing plus, realizable value. Let's understand. This is super important for examination. So let's talk about FOB pricing calculation. How do you go about computing the FOB pricing? So the first thing that we need to do, we need to compute what is the total FOB cost. That is called free on board cost. So what is the total FOB cost? As you can see that total manufacturing cost and packing and local transport cost. So it includes, manufacturing cost plus packing and local transport cost. So how much is the manufacturing cost? It is I think 35 lakh. Yes, it is 35 lakh. And what is the packing and local transport cost? That is 5 lakh. So almost it becomes 40 lakh. Okay, this is your FOB cost. Now second thing they have given is a profit margin, which is 10%. Now you tell me whether profit margin has to be added or subtracted. Please tell me. So cost, the manufacturing cost and packing and local transport cost. So obviously it has to be added. This margin has to be added, right? So profit margin you have to add. So what is the profit margin? So that is I think 25%, no 10%. 10% of 40 lakh. So that is how much? I think it is 4 lakh, right? 4 lakh. So final FOB price will be how much? 44 lakh. Just add both of them. Now export incentive is also there. 20% on FOB price. So tell me whether this export incentive has to be added or it has to be subtracted. What do you think? So export incentive has to be added. Please understand, this export incentive has to be added. How much it is? It is just 20% on FOB value. So 20% of 44 lakh, how much will that will be? 8.8 lakh. So final realizable value will be the sum of FOB price plus export incentive, which is equal to 44 lakh plus 8.8 lakh, which is equal to 52 lakh 80,000. That's it. That's the realizable value. So basically, you know, this realizable value is used by bank to check financial eligibility for pre-shipment or post-shipment credit, right? So that's the point. So one simple way to just summarize the point is that, you know, FOB price is equal to manufacturing plus packing plus profit. Manufacturing plus packing plus profit. And realizable value is equal to FOB price plus incentive. Okay, that's the point. So manufacturing plus packing plus profit, that will give you FOB, and you add incentive to that, that will be the realizable value. So these are the steps which you have to follow. First of all, we have to take manufacturing cost, packing cost, local transport cost, that will give you FOB. Add profit margin, that is FOB price. Then add export incentive, that is realizable value, and then convert to foreign currency if required, right? So these are the steps that we have to follow to compute the question was, what is the final FOB value? So answer is 52 lakh 80,000. Option number C is the correct one. Now let's look at the part number B. So second part of the question, let's have a look. So question is, you know, under the part B, after retaining 20% in foreign currency and deducting 12% interest for the 90-day period, what is the net credit that the exporter receive in their account? And 4 options have been given. So let's look at the part number B. What is happening here? That bill has been negotiated. Bill amount is $1 lakh. Retention in EFC account. You know what is EFC account? Exchange earned foreign currency account. 20% has been retained. That means bank will negotiate only 80%. Exchange rate buying is 82 rupees. Interest rate is 12% per annum. Transit and usance period is 90 days. So this data have been given. So you have to compute the what is the net credit the exporter receive in their account. Okay, so let's move through step by step. Let's go through the question step by step. So first of all, let's compute the negotiable amount. Okay, let's compute the negotiable amount. So how much is the negotiable amount? Clearly they have mentioned in the question that, you know, the bank negotiate only 80%, right? You can see only 80% bank negotiate. So that is 80% of bill. And how much is the bill amount? 1 lakh. So that is 80,000. 80,000 rupees is the negotiable amount, right? Or not rupees, it is dollar. $80,000, right? $80,000. That is the negotiable amount. Second thing we have to do is to convert into INR. So what is your gross proceed? Gross proceed is 80,000 multiplied by, you know, rate 82 rupees, right? 80,000 multiplied by 82 rupees, which is equal to 65 lakh 60,000. This is the gross proceed. That is how we convert to INR. Then interest deduction. Obviously in the bill, since it's a case of bill discounting, so obviously interest will be deducted. Interest is P into R into T upon 365. What is P? 65 lakh 60,000. What is rate? 12%. What is time? 90 days. They have mentioned upon 365. So that will give us 1,94,082. That is the interest. So what the question is asking you? The question is asking you to compute that what is the net credit. So what is the net credit to the exporter? It's very simple. Gross proceed we have calculated. Interest that will be charged by the bank we have calculated. So net credit. So this interest will be charged upfront, which is the gross proceed minus interest. That is your net credit. What is gross proceed? 65 lakh 60,000 minus 1 lakh 94,000 82. So this difference will give us 63 lakh 65,918. That is the net credit. So if you look at the option, yes, option number B is the correct one. Just wait a minute. This is the correct one. 63 lakh 65,918. So you can think of this net credit like, negotiable amount minus interest. Negotiable amount minus interest. Right. That's the thing. So what we have discussed, what we have learned so far, that bank negotiate 80% of the bill after EFC retention, convert to INR using buying rate, deduct interest for transit and usance period, and the formula is very simple. Now friends, let's look at the next question that they have asked. So this is the question that given that LC was silent regarding its nature, it has been given to you that LC was silent regarding nature, whether it is revocable, irrevocable, that's not clearly mentioned, but it stated that it was subject to UCP 600. What is the legal status of the cancellation attempt by the issuing bank? So LC is silent, right? LC is silent. So what is the legal status? So option A says that cancellation is valid because bank has right to protect its interest. B says that cancellation is invalid because LC silent on its nature is deemed irrevocable. C says that cancellation is valid as long as the issuing bank has not received the physical document. And D says that LC is automatically considered revocable because it did not explicitly use the word irrevocable. So friends, what does the UCP 600 rule say? So let me tell you, this is all about UCP 600 rule. If you are familiar with the rule, you can easily answer the question. So UCP 600 rule say that if the LC is explicitly mentioning it as revocable or irrevocable, right? So if you're not explicitly mentioning it, that is implicit. In that case, you treat it like irrevocable. That's a clear thing. You have to treat it like irrevocable. What is the meaning of irrevocable? It means once time you issue the LC, then issuing bank cannot cancel it single-handedly. See, once LC, when I say irrevocable, it means once LC is issued, right? Once LC is issued, the issuing bank, he cannot cancel it. He cannot cancel it single-handedly. So that's the point. So for that, for cancelling, consent of three parties required. 3 parties consent needed to cancel or to revoke. Who are the 3 parties? First is the issuing bank. Second is the confirming bank. Third is the beneficiary. Right. So unilateral cancellation by issuing bank is not allowed. That is the point of irrevocability. Right. Now let's come back to this question. So what is the correct answer to this question? What do you think? Yes, B is the correct answer. Because cancellation is invalid, because LC silent on the nature is deemed irrevocable. You cannot cancel it unilaterally. You have to take consent of all the 3 parties. So option number B is the correct one. Right. So please remember, silent LC, if LC is silent, so it is a strong LC. Why strong LC? Because a strong means irrevocable. And irrevocable means, it cannot be cancelled by issuing bank unilaterally. So article number 3 will apply. Article number 3 says the same. Default means irrevocable, and irrevocable LC, for cancellation of irrevocable LC, you have to take consent of all. You cannot cancel it on your own. Now this is a very good question. This is a case study type question. Let's understand. Now this is the second part of the question. Suppose the LC, this is the tricky question, that LC is explicitly marked revocable. So the LC was explicitly marked revocable. Negotiating bank took up the document and paid the exporter $2 lakh at 10 AM on 15th May. The issuing bank cancellation notice was received at 2 PM on 15th May. What is the financial liability in this case? So the LC is explicitly marked as revocable. In the previous case, it was not explicitly marked, rather it was implicit. Now they have explicitly marked it as revocable, and the negotiating bank has already paid the exporter, and then the issuing bank sent a cancellation notice letter. Right. Cancellation notice was sent later after I think 3 hour or 4 hour later. Who bear the financial liability? Option they have given that negotiating bank loses the money as the LC was revocable. B says that exporter must refund the money to the negotiating bank immediately. C says that issuing bank is liable to reimburse the negotiating bank for the full $2 lakh. And the D says that liability is split 50-50 between the issuing bank and the negotiating bank. So let's look at the scenario first. So what the scenario is like, LC was marked revocable. Just wait a minute. Let me write it down. LC was marked revocable, right? And this negotiating bank, what they did, they paid the exporter $2 lakh at 10 a.m. on 15th May. And issuing bank cancellation notice arrived at 2 p.m. on the same day. So option they have given that negotiating bank lose the money, exporter must refund the money, issuing bank is liable for the entire. So basically, when I say revocable LC means issuing bank can cancel it without the consent. However, there is an important rule. The important rule is that if the negotiating bank has already accepted the document and made the payment before receiving the cancellation notice, the issuing bank is obligated to honor that payment, because in this case the same is happening, that this negotiating bank has already accepted the bill, accepted the LC, and is also made payment before the LC was made revocable and sent to the negotiating bank. In that case, the entire liability lies with the issuing bank. So payment was made at 10 a.m. and the cancellation notice arrived at 2 p.m. So the payment happened first. So issuing bank is responsible, right? So that's the point. Please understand. So what we came to know that, revocable LC you can cancel anytime. Since it is revocable LC, you can cancel anytime. But respect the past action. You have to respect the past action. Think of it like this way. Revocable sound like reversible. But what is done before the notice cannot be reversed. Right. So option number C is the correct one. This is the correct one. Please understand. So revocable LC can be cancelled without consent. But if payment was made before notice, issuing bank must pay. That is the point. Now a very good question before you. Let's have a look. So this is the entire question that XYZ Trader Mumbai is finalizing a contract with ABC Corp Dubai to export a specialized machine part. So a contract between XYZ and ABC Corp to export what? A specialized machine part. Total shipment weight is 15 ton to be shipped from Mumbai port to Jebel Ali port. So some cost have been given like X factory cost, packing and loading at factory, inland transport to Mumbai port, port loading charge, sea freight to Dubai, marine insurance, unloading at Jebel Ali port, import duties, and and taxes in Dubai. So these costs have been given. The parties are evaluating which Incoterm. So this question pertains to Incoterm. The parties are evaluating which Incoterms to use to determine where the risk transfer and who pay the cost. So the first question is, if the XYZ trader and IBC Corp agree on FOB Mumbai Incoterm 2020, what is the total amount in rupees the exporter will charge on the invoice to cover their cost? The option they have been given 50 lakh, 51 lakh 30,000, 51 lakh 60,000 and 53 lakh 30,000. Very good question. So FOB Incoterms is being used. So please understand. So we will clarify each and every concept related to Incoterms using this particular question. So under FOB, what is FOB? FOB stands for free on board. That's the meaning of FOB, right? That's called free on board. So basically, what happened, that the seller responsibility end once the goods are loaded on the vessel at the post of shipment. So this is the port, right? This is the port. Once the goods are loaded on the ship, seller responsibility end. So that is called FOB, right? So in this case, what are the costs that the seller cover? So till loading, before loading, what are the costs? Like factory cost seller will cover. First thing is the factory cost. Second thing is the packing and loading at the factory, inland transport to port, and loading charge. These are the charges that seller will cover under FOB. So please add all of them. 50 lakh, 50,000, 80,000 and 330,000. So that add up will give 51 lakh 60,000. Right. But this cost like sea freight, marine insurance, unloading, import duties, right? These are the buyer's responsibility. That's the bifurcation. These are the seller responsibility. So if you understand FOB, that is called free on board. Till on board, seller will pay, and after that, buyer will be responsible, right? So FOB, you can think of it like this: seller pay the goods till the goods are on board. On board means what? On board means on the ship. Seller will pay. Seller will, seller will compensate for all the cost that is incurred till the goods are on board, and after that, seller's job end at the ship rail, right? So the correct answer to this question is very simple question. You just have to add all this cost before on board. That is 51,60,000. That's it. Now let's look at the next question. Now we have shifted to CIF. Under the CIF, that is cost, insurance, freight. Let's tackle another important Incoterm question. Under the cost, insurance, freight Incoterm, a storm damages the goods while the ship is in middle of the Arabian Sea. Who bear the physical risk of the loss? XYZ trader, who is the seller, ABC Corp, who is the buyer, the shipping company, and the Mumbai Port Authority. Yes, very good question. Because of a storm, the goods was damaged when the ship was in the middle of the Arabian Sea. Who bears the physical risk? So here is basically, what happened under CIF. You know what is CIF? CIF stands for cost, insurance, and freight. CIF. So what happens, the seller, in the case of CIF, the seller pays for cost, the seller pays for insurance, and the seller pays for freight. That's called CIF. But the risk transferred to buyer. The risk will transfer to buyer once the goods are loaded on the boat and the ship at the port of origin. Once the goods are loaded, so the risk will transfer to the buyer. So even though the seller, who is XYZ, he has paid for freight and insurance. Seller has paid for freight. Seller has paid for insurance. Even though he has paid, the moment good crosses the ship rail in Mumbai, the risk will shift to ABC Corp. That's the point. And if the damage occur during the voyage or during the transit, the buyer must compensate from the insurance company, not the seller, right? So buyer has to compensate. That's the key point regarding CIF. That is how you should learn it, right? So the answer to this question is, the buyer. Who is the buyer? Obviously, ABC Corp is the buyer. He will have to compensate. So you can think of it like this. Please understand. In the case of CIF, seller pay for cost, insurance, and freight, but risk shipped at the port of shipment. So seller pay the bill, but buyer carry the risk. So CIF means seller cover cost, insurance, and freight. Risk transfer when the goods are loaded on the ship. Buyer claim insurance for any loss during the transit. I hope it is crystal clear. Now the third question of the same case study, that if the buyer, now let's look at a situation where buyer want the seller to handle everything from the shipping to custom clearance and even paying the import duties. So which Incoterm apply here? So if the buyer, which is ABC Corp, want the seller to handle the entire process, including custom clearance, paying the 4,50,000 import duty at Dubai, which Incoterm should be used? CIF, DPU, DDP, EXW. So basically the answer is DDP. That is, this is the Incoterms where seller has the maximum responsibility. Seller has the maximum responsibility. This includes, when I say maximum responsibility, it includes, export formality. Right? Export formality, seller has to do. Shipping cost, seller has to incur. Insurance cost, seller has to incur. And delivery at the buyer location, seller has to incur. Import duties and taxes, seller has to incur. So in this case, if ABC Corp want XYZ trader to pay the 4,50,000 import duty at Dubai, so DDP is the only correct choice. Yes, DDP. That is called delivery duty pay. So you can think of this DDP like, door to door with duties paid. Seller does it all, right? Now the fourth question. XYZ trader realizes that they have their own unloading equipment at the destination terminal and offer to unload the goods themselves. Which specific Incoterm is designed for this scenario where the seller is responsible for unloading? Very good question. So the answer is DPU, delivery at place unloaded. Because under DPU, the seller is responsible not only for delivering the goods to the agreed destination, but also for unloading them from the arrival means of transport. That is different from DAP. DAP where what happened, seller delivered the goods ready for unloading, but the actual unloading is the buyer responsibility. In the case of DPU, the seller is responsible for unloading also. And finally, if the seller pay import duty also, that is called, the first one, which was, DDP, delivery duty pay. And then we have the total landed cost for the buyer if the transaction is done on EXW. So if the transaction is done on EXW, that is called X work basis, assuming they pay all the listed costs from the factory onward, what is the total landed cost for the buyer? So under EXW, what happened? The seller responsibility end at the factory gate. The buyer bear all the cost. So once the good crosses the factory gate, seller responsibility end, and the buyer will bear all the cost. So if the Incoterms is EXW, so what buyer will pay? See, buyer will pay the X factory cost, this one, packing and loading, this one, import, this one, everything buyer has to pay. If you add all of them, this will give you 58,25,000. So this buyer has to pay because it is in EXW. So here seller has minimum risk and buyer has the maximum responsibility. The answer is 58,25,000.